been spreading the good news, not the gospel, but finance. So there's still good news. So real fast, we want to make sure we get to your questions, so we're going to make this thing as brief as possible, because I know you all have a lot of questions. So without further ado, I want to introduce one of the greatest accountants, CPA, certified financial planner on this side of the Mississippi, JP.
Yesterday I woke up and had to go see my urologist. I can't tell you how excited I was to wake up yesterday morning and say, oh boy, I get to go see the urologist. Today, all of you woke up this morning and said, I can't wait. I have a discussion on taxes this afternoon. So my challenge today is, one, keep everybody awake. And two, try to give you some idea as to what's going on and what has changed with the introduction of what is commonly called the Big Beautiful Bill. I'm going to start with the secret. Politicians lie. So here's some things that we've heard in the previous few months. How many of you have heard no tax on tips? How many of you know what the truth about that is? No tax on tips up to the first $25,000. And then after that, it reverts to what it has always been. No tax on Social Security. I got to tell you, I was really excited when I first heard that a few months ago. We're going to explain that in depth a little bit today. How many of you are interested in knowing the truth about no tax on Social Security? That's what I thought. No tax on overtime. Yeah, who cares? Republicans are gutting Medicare. Oh, and here's the other thing. We're going to make the tax cuts permanent. I'm not sure that's true either. Some will talk about the origins of the federal tax system. This is not your cue to go to sleep, Jim. The federal tax system was first introduced in 1913. The tax form was 1 page with 3 pages of instructions. The first 2/3 of the page was information about your taxes. The tax table was the bottom third of the page. There were several things on this tax form that are true about today's taxes. It contains standard deductions. If you were married filing jointly, you had a standard deduction. If you were single, you had a lower standard deduction. It was a progressive tax system that started at 1%. 1%. It moved up. The top tax bracket was 6% for people that made over $500,000. $500,000 in 1913. I don't know what that translates to in today's dollars, but it's a lot of money. Maybe Elon Musk is in that bracket. I don't know. But 6%. That's a pretty good deal. This is the other interesting thing. You filled out your form, but you didn't mail it in. The tax man came to your house and sat down with you and reviewed it with you. And then he went back to his office and bills were mailed out for your taxes on June the 1st. And you had to have your check in the mail by June the 30th to pay your tax bill. When Congress passed the legislation in February, Well, they started the taxes beginning March 1st. So the first year that you had to pay your taxes was a partial year, but they wanted to make sure they got you from March through December. If they didn't pass it, they couldn't make it retroactive. But how many of these things do we still have today? Well, we still have the standard deductions. We have differences between married and single. We have a progressive tax system. In 1943, the largest federal tax bracket was 96%, 94%. So then you stack your state taxes on top of that. Now there's one person that all of us know his name, Ronald Reagan. In the 40s, Ronald Reagan, what was President Reagan doing in the 40s? He was doing movies. Ronald Reagan would film a movie. You know what he made per movie? $100,000. It took him 3 months to film a movie. So he'd finish the first movie, he'd get his check for $100,000. He'd film a second movie, he'd get his check for $100,000. And by the end of June, he had made $200,000. And if he made a third movie for $100,000, the federal government wanted $94,000 of it. And the state of California wanted 5-6% more. So Ronald Reagan, it cost him money to make the third movie and the fourth movie. And so he made 2 movies a year and he quit. Just like all of us would do. Because why work anymore if you're going to have to give 100% of it back to the government? Which is why in 1987, Ronald Reagan had the tax code changed. It affected him. By the 1970s, the marginal tax rate at the high end was 70%. So we had managed to bring it down from 94 to 70, but that's still a lot of tax. Today, the wealthiest Americans pay a top marginal tax of 37%. It was 39% before Trump had it changed in 2017. But here's the problem. There's a gotcha still coming. And the gotcha is this. If you take the money that we pay for Social Security, Medicare, Medicaid, and debt, our national interest on our national debt, that makes up 76% of the budget for the United States. So think about that for a minute. We have 26 cents out of every dollar of income to pay all other social services, our national defense, our border security, our space endeavors. How long can we go on if that is what our budget looks like? I suggest to you today that there's no way, while the tax cuts may remain permanent, the tax brackets themselves cannot. And it's not a Democrat issue, it's not a Republican issue, it's another 4-letter word. You know what the 4-letter word is? Math. It's a math problem. So it's going to have to change yet again. So permanent are the tax brackets. The tax brackets range from 10 to 37%. We don't have the 39% anymore that we had prior to 2017. But what are they going to do to change how much tax we have to pay. Well, they're gonna make the thresholds different. And I'm not convinced at all that 37 is gonna remain the top tax bracket. How many of you are concerned Social Security is gonna go away?
Not in my lifetime.
There you go. Not in my lifetime. See, there's a right answer. Let me try this on for you. Hi, I'm J.P. Goble. I'm running for Congress as a member of your party, and we have to change Social Security. We're going to have to probably grossly reduce the benefits paid by Social Security. How many of you can I count on for your vote? Yeah, one person who probably needs to have his hearing checked. But you know what I'm saying? And that's the problem. That's the problem. And so what we have to do is we have to change how our income is constructed so that the tax train doesn't hit us. And the other problem is this. We don't know what the tax train coming toward us, what it looks like. What are the rules going to be? See, when we go start to play a game, we know the rules. I officiate football at the high school level. I know what the rules are. Coaches ought to know the rules, some of them do. Players ought to know the rules, some of them do. But we know what the rules are before we kick off. We're not creating rules as we go. And now we're in an era where the rules are changing. Things are happening at such a rapid pace to us today, and we wish we understood what the rules were going to be, but the truth is we don't. How many of us really understood at the beginning of the year what tariffs would do and how that would affect our economy? Anybody really understand that? Yeah, very few. We don't know what the rules are going to be. We kind of know what the skeleton looks like. We know that since 1913 there's been a whole lot of things that haven't changed, but we don't know exactly what's going to change. And our politicians have, with the one big beautiful bill, they have introduced some things that just kick the can down the road past the next presidential election. So some things have changed in my world. Some things that I told my clients as recently as 1 and 2 years ago are different today. There's for seniors, this is where the change starts. How many of you do not itemize your deductions? You take a standard deduction when you file your taxes. Any of you take a standard deduction when you file your taxes? For those of you that take the standard deduction, I have really, really good news for you. So let me tell you what that is. We have the initial standard deduction for seniors that starts at $15,750 this year. And then if you're single, you get an addition, that over 65 deduction that we've had for the last several years. If you're single and file a single tax return, that's $2,000 additional standard deduction. If you're married filing jointly, it's $1,600 a person. So that'd be an additional $3,200 for the couple. Okay? And then we have this enhanced deduction for seniors that the intent is that this will cover your taxes for your Social Security so that you end up at break even on taxes. And it is an additional $6,000 a person if you are 65 at the end of 2025, that you'll get this additional $6,000. Oh, but there's a mistake in the printing of the bill. And until Congress clarifies this, it doesn't go into effect this year. Now, I fully expect that by the time the tax forms are available, it'll be clarified and you'll get the $6,000 deduction for 2025. But under this bill that was passed before the legislators read it, when they read it, they'll find out that it doesn't have a start date to it. Oh, but there's some phase-out limits if your income is too high. So, depending on what your income level is, you might not get the full $6,000. Let me just ask, is anybody else disappointed by that? If you itemize your deductions, this doesn't apply to you. If you itemize your deductions, the no tax on Social Security doesn't apply to you. Is anybody disappointed by that? Can you all tell that I'm just a little bit miffed at both sides of the congressional aisle? I am very disappointed in the person that I voted for and the person that I voted against and their party. But how long do you think it's going to be before that's corrected? Not in my lifetime. So I'm going to try to go through this again a little bit easier if you can see this. This is a summary. The standard deduction for those of us that are 65 and over, the standard deduction is $15,750. To that, we add the 65 and over deduction that we get, which also, if you're blind, you get that twice. And then we get this bonus deduction of $6,000 a person, as long as we don't make too much money and the IRS starts taking it away from us. And that's not fair. It's not the IRS. It's Congress. Congress will start taking it away from us if we make too much money. Okay? We've heard so much about it. Here's all the changes to Social Security. How many of you are scared about the changes that have just been made to Social Security? How many of you have heard something that have made you concerned about that? Here's the changes. Bottom line for taxes. If you itemize, nothing has really changed. If you don't itemize, but you take the standard deduction, things probably have changed for you. But if you make too much money, they're going to start taking it away from you anyway. Okay? In general, the one big beautiful bill is a benefit to middle income and lower taxpayers. Upper middle income and higher, it's not going to help. That's a broad brush. Okay? I'm sure we will find exceptions. But that's the translation of no tax on Social Security. Changes to Medicare. You know, all the things that change every year about Medicare, and you have to go re-enroll in Medicare every year in October, you're still going to do that. That's going to be the same. Nothing else has changed in Medicare for 2025. Is it going to change? I believe it is, because of the math problem we talked about earlier. But there's no changes right now for Medicare. For those of you who actively give to charities, this is probably going to change what you do. For years, as a financial advisor, we have done something since 2017 that we call bundling charitable contributions. Any of you ever heard of bundling before? So for those of you that don't know, I'm going to use simple math. I like simple math. Simple math is anything I can do in my head, which usually means it's divisible by 10. So let's say that your standard deduction is $10,000 a year. Okay? But you want to itemize. Well, you have to give at least $10,000 a year to a charity for you to itemize your deductions. Okay? Well, I had clients that wanted to tithe, but tithing wasn't helping their tax situation. I'm trying to choose my words very carefully in case there's a preacher in here. I am not speaking against tithing. Okay? My church needs my $10,000 every year to keep the doors open. Okay? So what we did was we had this thing called donor advised funds, and we would bundle deductions. And so in 2025, I might give $30,000 to a donor advised fund, and I would take the $30,000 itemized charitable deduction this year. And then I would ask the donor advised fund to send $10,000 to my church. And then next year, I'm going to ask the donor advised fund to send $10,000 to my church, so my church isn't negatively impacted. But year 2, rather than itemized deductions, I'm going to take the standard deduction. Well, the standard deduction, based on the One Big Beautiful Bill Act, that might be good. That might be good for me, and that might work okay. But it might not. It might not be so good. I might have so much in my standard that it's not helping me to itemize. Okay? Year 3, because I'm a Baptist, I might have changed churches, and I need that $10,000 to go to my new church, not my old church. Well, I don't control the money anymore, but I do still have some influence with the donor advised fund to send it to my new Baptist church instead of my old Baptist church. And I'm still going to take the standard deduction that year. And the next year I would have planned and put $30,000 back in my donor advised fund. Based on the One Big Beautiful Bill Act, my clients that have done the donor advised fund and bundling thing in the past, we're looking at doing qualified charitable distributions instead of donor advised fund and itemizing. A qualified charitable distribution, what that means is, let's say that the IRS has sent you a form and you are aware that you have to take $10,000 this year from your IRA. That's your required minimum distribution, and you have to take it. Well, something that you can do is you can have, if your IRA is at Fidelity, you can contact Fidelity and say, instead of sending me, don't send me that money. Please don't send me that money. I want you to write a check to my church and send them $10,000. Okay? So now, if you previously made $100,000, if your modified adjusted gross was $100,000, well, because that $10,000 went to the church and not to you, your income starts out at $90,000. Okay? Your church is not impacted. It still looks to them like a charitable contribution. The only thing that changed is your tax return. Because now you started $10,000 lighter with your income calculation. So by starting $10,000 lighter, well, now you have less money to be taxed on because that money didn't come through your checking account. And so every one of my clients that have been doing donor advised funds in the past, we're having to look at it and see what's best for them. Is the donor advised fund still the best way to go? Or do we need to change the strategy to look at qualified charitable distributions as a way to continue to support our church and help our tax situation? Does that make sense to everybody? The problem is, if any of you have questions on that, it's really hard to answer that in this room. Oh, I forgot something. Here's something that matters. I don't know, if this matters to you, please let me know. You and I need to have a conversation. The estate tax, gift tax, and generation skipping transfer tax thresholds increased to $15 million starting in 2026. If you need somebody to gift $15 million to, I have a business card for you. Even if that person's not me, even if that person is your grandchild, maybe some crumbs will fall my way. If you're in the 37% tax bracket, your itemized deductions will be capped at 35% of your adjusted gross income. If that applies to you, I need to talk to you about gifting strategies as well. Here's something that might apply to you. We're going to hit all sides of the spectrum. Up until this year, if you bought an electronic vehicle, there was a tax deduction of some sort available to you. Well, now that a different party has taken control, now if you buy an American-made car, up to $10,000 of the interest is tax deductible to you. I don't really think we're helping anybody, but the politicians think this makes it look better. So, to recap, you may or may not be better off with the taxation of Social Security the way it's laid out. And if you have questions about it, if you'll bring me last year's tax return, I'm happy to sit down with you and we'll talk about it. Here's the problem. Most of us don't do any kind of tax planning, period. Most of us wait until the end of January when the forms start coming in, and we gather those forms and we take them to our tax preparer, and we say, here's what we did, give me the best deal you can. Well, December 31st closes your time to make charitable contributions. Your time to have prepared, your time to have planned and done the right thing with your charitable contributions has vanished by the time you start your tax preparation. Don't assume that this year things are going to be like they were last year. They may be like they were last year, but they may not be. One thing that has changed, that you can benefit from this, even if you can't benefit from anything else, if you do not itemize your deductions and you take the standard deduction, do you all remember that in 2016, you could take $300 as a charitable contribution? All of us walking around Memphis, even if we didn't tithe, we gave away $300 to the high school band or the Girl Scouts cookies or something. All of us gave away $300. If I had clients back then that weren't taking $300, I said, you gotta be kidding yourself. They've put that back in, but it's not $300. It's $1,000 a person now. So we can give $1,000 a person, so if we're married, filing jointly, we can give $2,000 as a family, and that $2,000 is deductible even if we do not itemize our deductions. So our Social Security income we have to plan that. Our charitable contributions, we have to plan that. And something else has changed with the introduction of the big beautiful bill that I have done a few times, but I had quit talking about this as a tax strategy to people our age, because I expected Congress to do something about this and they haven't. If you have money in an IRA that you're having to do R&Ds with, and you don't plan to die within the next couple of years, Roth conversion strategies might be something that you have never considered before because of your age, and your financial advisor has said that's not going to help you, but it might. It might help you. The analysis that I've done shows me that if we start Roth conversions now and can get money moved from IRAs to Roth IRAs, I'm sorry, let me back up. Let me make sure everybody knows the language I'm using. Your IRA was funded generally through a 401k, but the money went into a 401k and came out of your taxable income, so you did not pay tax on the money that went into that IRA. The IRS has allowed that money to grow tax-free and tax-deferred. When the money comes out of that IRA, the IRS is going to tax you on that. Problem is, if you've got a significant amount of money in your IRA, well, now the IRS is dictating how much of that money every year you're going to take out. Because the withdrawals are based on two things. The balance of the account, 12/31 previous year, and how old you're going to be at the end of this calendar year. And there's a table. And you just plug the numbers in, and there's a number that says this is what you have to take out of your IRA, and you have to, and that's what you're going to be taxed on. And so the IRS becomes your partner in planning your income. Let me say that again. The IRS has become your partner in planning your income. How many of you find comfort in that? So, the other thing we can do is we can take that balance of the IRA and we can start moving that over into a Roth IRA over a series of years in what we call Roth conversions. Now, it's not free. When we take the money out of the IRA, we have to pay tax on that. But we put it into a Roth IRA. What tax do we have to pay to do that? It depends. See, once it's in the Roth and we take it out of the Roth, we pay nothing on it. Even if we outlive it and send that to our children or our grandchildren, they inherit that money tax-free because you paid the tax on it. But we have to look and see, what tax bracket are you in now? What kind of tax are you going to have to pay on what we move over? And we want to look at that. If you're in the 20% tax bracket, and we jump you up to 22, that may or may not be a good thing. If you're in the 22% tax bracket, and we move you up to the 35% tax bracket, that might not be a good thing either. But the other thing we have to look at now is we have to look at IRMA. How's this going to impact my Medicare? How's this going to impact my Medicare bill? And for Medicare, they look back 2 years ago. Medicare is always looking at 2 years. So when we start doing Roth conversions, we have to look at the impact on IRMA and make sure, this may be great, I move into something that's tax advantaged, but if my Medicare is going to double in price, that's not necessarily going to help me. But we have to look at that and see what makes the most sense. And so when we talk about Roth conversions today, I'm looking at what's going to benefit you the most. I'm trying to plan taxes, not for this year, but 8 and 10 years down the road. How can I minimize your tax burden? How can I maximize your pot of gold at the end? And how can I keep your churches happy so when you show up there, they still give you communion? Okay? Those are the 3 areas where you're most impacted. Is my Social Security taxable or not? And I don't know, but I can help you look at it and help you figure it out. How do I keep my pastor happy? How do I do my charitable contributions correctly? How do I set aside the $15 million available for my grandchildren? Is that okay? And do I need to do Roth conversions? Because see, once we get the money into the Roth, as we pull the money out of the Roth, not only is it not taxable, you don't even report it on your income tax. So if it's not reported, how can it be taxed on my income tax? It can't be. Which is the beauty of having the money in the Roth. But for most of you in this room, your advisor hasn't talked to you about a Roth conversion in forever, because that would have been me. And I wasn't doing that for people after they retired. But now it's changed. And now I'm talking to older people about Roth conversions. And I'm saying if you're in relatively good health, this is something that we really need to consider. Okay? So those are the 3 areas. Are there other pieces of the one big beautiful bill that impact your family? Yes, there are. There's other pieces of this that impact your kids and your grandkids, and maybe your friends and maybe your neighbors. But I've tried to focus this on the impact for seniors, which is most of us in this room, with a few exceptions of some staff members that snuck in at a very young age. Does anybody have any questions about any of this? Questions? I'm looking around the room, I don't see anybody asleep. So that's good. Yes, ma'am?
Is there a standard way to decide whether you should take the standard reductions or have it itemized?
Well,
How do you know which one to do?
and here's the thing, and this is one of the things that comes out in this group, because at the end of the year, you all get a letter from Kirby Pines telling you what percentage of your monthly maintenance fees are for health care. And so it's going to be simple, because if that's all the itemized deductions that we have, well, then we have to compare that plus our charitable contributions and see, is that more than my new standard deduction? And then it just becomes, I really honestly believe if I look at the numbers and I tell you, you can pay $5,000 or you can pay $7,000 in taxes this year, you'll be able to tell me which one you want. Right? But the problem is, until we look at it on paper and determine, I can't tell you.
So my CPA should
Your
look at
CPA,
this and advise me accordingly.
that's exactly right. Take the numbers to the CPA. I would say, if you have projections, go ahead and take the numbers to your CPA now and say, what do you think? Because this gives you a chance to plan. Because if what we're paying in health insurance that is an itemized tax deduction, if that raises to the level of itemizing, this would be a great year to pump up my charitable contributions and go ahead and take all of that. And then maybe next year, I'm taking the standard deduction and not itemizing. Yes, sir?
So your standard deduction, if it's what, about 30,000 per couple?
Yeah.
Okay, so when I itemize every year, once I see if I don't have 30,000, I just scrap all of it.
Right. Exactly right. You know, when we changed all this, I mean, you know, most of us used to keep track of all the pharmacy receipts and whatever else. And then when this changes, I said, you know, I've got tax clients. I said, stop doing that. Unless you go to the hospital, you're never going to get there. Well, he went to the hospital last year. So now we did the work, and he still ended up taking the standard deduction because it wasn't enough to overcome the standard deduction. Sir, did you have a question?
Well, I did, but I think you already covered it. I'm interested, if it's an appropriate question, is your family medical staff a not-for-profit or a for-profit?
No, we're a for-profit. Right now, we're a non-for-profit trying to be a for-profit company.
Okay. I want to compliment you. I have some other questions, but I want to compliment you because I came to this expecting some kind of sales talk.
That's why we're a not-for-profit.
No,
I'm not very good at sales.
So you have laid all of those things out. Now, I'm pretty savvy when it comes to those things, and I give my accountant quarterly what I'm going to do and what my estimate is. So you know, what you're suggesting to people, most people don't want to do that. I like working with numbers. But you did an excellent job, sir.
Thank you. Did y'all all hear him say I did an excellent job? Anybody else have questions? Randy, do you want me to show that, see if I can get that up here on the screen?
I would love for you to do that.
All right, I told Randy if we had time, I would try to show you something else. So on the screen here is the financial modeling system that we use at Your Family Matters. And I took some fictitious numbers from a real person, and I took that person's name off of them, and I just renamed him a Kirby Pines resident. This person has just over $1 million in assets. He's got some money in cash. We've got money in the bank here. Not exorbitant amounts, but a checking account, a money market account. We've got investments of almost $1 million. He's got a health savings account of $10,000. He's got a couple different IRAs. He's got an IRA worth $725,000. He wanted to have some gold, and so he's got a separate IRA that just has nothing in it but gold of $117,000. And much to his advisor's chagrin, it has grown. He has a Roth IRA. And he has a brokerage account. He bought a house because just prior to his retiring, he got divorced, so he had to start over. He's got a house, and he still owns roughly $55,000 on that house. And we started looking at what would happen if he sells his house and moves to Kirby Pines. So for him, we started with some tax analysis, and I uploaded a copy of his tax return, and we started playing with things. And for him, we found out when we ran through this and solved for the best tax strategies, that if his assets were located between taxable, tax-free, and then tax-deferred, if he withdrew from the taxable, then the tax-free, and the tax-deferred, and then we used a Roth conversion strategy of IRMA plus $220 a month, that what that would mean, and I carried him out to say he lived until 96. If my 70-year-old client lives until 96, he'll end up with an additional almost $2.5 million in assets at the end.
What is PERMA?
I'm sorry?
What is PERMA or IRMA?
IRMA, it's the income adjusted return, that monthly amount of money that we get, that Medicare looks at to determine what our Medicare premiums are. And so we're very concerned about the impact of the out-of-pocket expense of Medicare. And so that becomes part of this analysis. So we look at that, and then when we started this, I want to show you how important this is. See in the bottom left-hand corner, he has $50,000 in taxable assets. That's the combination of what's in the bank and that brokerage account. He has $842,000 in tax-deferred assets. And a year ago, we started Roth conversions. And so now he has $65,000 in his Roth IRA account that before he didn't have anything there. Well, now that we've got, now with the one big beautiful bill, my friend is 70. We're going to start doing $125,000 a year Roth conversions. He almost died of the sticker shock when we paid the tax on the 65 last year. But he's going to end up better off. And the reason is because in 2034, when the tax law changes, he's not gonna, his RMDs are gonna be roughly $13,000 at the high and go down from there. And after 3 years of the continued Roth conversion, we're gonna be doing Roth conversions over the next 8 years. But after that, his RMDs are gonna be zero from his IRAs. So whatever he has to tap out of his Roth is non-taxable. Whatever's left there will go to his heirs tax-free. And he's going to end up with a higher probability of success in retirement because this allows me to model if he wants to do $14,000 in donor advised fund contributions, we can put it here, or I can take it out. I can model donor advised funds every 3 years. He's got a $25,000 pension income. We're gonna sell his house and he's gonna move to Kirby Pines at the end of the year. We're going to use the proposed tax strategy that we just showed you on the screen instead of the current tax strategy. And once we do all this, and I hit refresh, if he lives to 96, when he passes, we're going to have roughly $2.4 million to go to his heirs. Now, yes, sir.
I was just going to comment and just ask a question too. That man, that example that you're giving, is agree with everything you said. The one caveat would be you have to know that statistically, he's in reasonably good health, and he has a good chance of living past.
Go ahead.
They can't get at that money.
Living past when?
Well, living, because when you, as you're converting, my understanding, and I could be wrong, he can't get that money, he can't start taking it out for 5 years. So if he has a life insurance.
He can, okay, the question is, when the gentleman starts the Roth conversions, he can't get that money for 5 years. Let me explain that. He has to wait 5 years to take the growth out of that. The $65,000 he put in there a year ago, he can take $65,000 out anytime. He's paid tax on it, it's his money. So he can access the $65,000. If I, as his advisor, if I help him grow that money, he cannot access the growth for 4 more years because the clock started on the 5. So I'm going to talk out of school for just a second. Your financial advisor doesn't talk to you about this. Why? They are paid based on how much of your money they have that they care for. And to do a Roth conversion, your balance goes down. Your advisor's paycheck goes down. He doesn't want to talk to you about your Roth conversion. So, I worked for Edward Jones for a long time, for a few years. You know how many, in the 5 years I worked for Edward Jones, you know how many Roth conversions I talked to my clients about?
Can I ask one further question on that?
Yes, sir.
That's an excellent explanation that you did. And I'm not clear on this, I hope you can answer it. That if I converted over a period of time, say $300,000 from my IRA to a Roth, say I did it over 3 years, and that $300,000 that's now in my Roth is still available to me, but any earnings are not available. Can I, when I start taking out of the Roth, will I have to take some of it as earnings, or can I specify, I want $30,000 for my balance?
Yeah.
Yeah.
You specify how that money comes to you.
That's excellent.
Other questions? Anybody else? I'm happy to answer questions all day. At the risk of boring people, I'll give you a business card. You can come visit with. I'll come here and visit with you. I want you to be educated. I think that if you're educated, if we know what the options are, most of us can pick the big one. When it comes to money, most of the time the answer is pick the big one. Pick the big one. If I can show you a couple of different options, if I can narrow it down to 2 options and give you those options, I think you'll make really, really good choices. Anybody else? I really do appreciate your attention today. Those that almost fell asleep had to get up and leave, and that's fine. I get it. I was concerned about my high school biology teacher being much more interested in biology than I was. So I went and found something more exciting to talk about: taxes. Thank you all today.
Okay. Guys, let's give it up again for JP. I think that was a great presentation. The objective here was to tell you a little bit about the big, wonderful bill, but at the same time tell you that if you're not talking to your financial advisor and you're not talking to your CPA, this could be very detrimental to your financial future. We're going to be using JP to help us with Kirby Pines Prospects, because this financial model is something that is not common out there. This is something that I think is unique, and I think it would be very beneficial if you don't have somebody actively helping you actively manage your finances. Okay? So again, thank you, JP. Thank you, Thomas, for coming in, and we look forward to having you back again. So thank you, guys. Make sure that you take advantage of the goodies over here, and we'll keep you posted on the next seminar we do with JP. So thanks so much. See you guys.